Hello, Risk 4909. Today we will be presenting on American Barrick, specifically the management of gold price risk. My team members are Jonathan, Kayla, Maud, and I will be your presenter today. And we begin with the industry, the American Barrick's value chain. The chain starts off with exploration, acquisition, to eventually develop a mine process to be able to finalize and sell the gold. The chain specifically adds value to American Barrick by starting from discovering new mines or acquiring existing ones to moving into the development of the mines process where they gain more insight through new members and new techniques. If you can see here, these first three phases ultimately ended in the selling of gold, then rounding back to the first phase. This value chain was specific to American Barrick by increasing mines, staff, knowledge, and gold, creating the most value for the firm. Now we get into more detail on the exploration and acquisition. American Barrick began its journey by exploring mines across the Northern America, specifically in Canada and Alaska. They had a handful of mines around these areas and then began to acquire more mines. Acquiring more mines meant that they would buy them from existing companies and gain all the access to them, including their staff, the engineers, the equipment, and the history of the mines. Most of their acquisitions ended up being incredibly lucky. For example, when they acquired the Camflo mine in Nevada, they also acquired Robert Smith, who was a remarkable engineer and who later became the president of American Barrick. By acquiring existing equipment, they did not have to purchase anything, and the equipment would also be set up. An example of convenience in acquiring a mine would be the Purple Vein, which was 1 mile north of the Gold Strike mine. They were able to use all of the same equipment for the exploration, which helped save in fixed costs. The Mercer mine was the first mine that was acquired by using bullion loans. These loans were with Toronto Dominion Bank, where they would enter into an agreement with Barrick, where their collateral was the mine itself, in which they would pay the bank back in gold, where the bank would then turn around and sell the gold on the market. Barrick would pay the bank in monthly installments with an interest of about 2% a year, and then was required to make accelerated deliveries. After the Mercer mine was successful in raising capital by bullion loans, Barrick then acquired the Gold Strike mine through with these loans. Continuing with the industry, and now specifically from the chain, the development of the mine process to selling gold. Starting with the development of the mine process, acquisitions did play a vital part, one for gaining experienced engineers and for gaining mines that ended up having more ores than previously known. When Barrick acquired Camflo mines, they also acquired Robert Smith, who once again was a very skilled technical engineer. They also acquired Gold Strike, which they could gain a competitive advantage with them if they could develop a new technology to mine for gold. With the combination of an expert staff and highly potential mines, their competitive advantage grew, thus creating themselves a higher position in the gold market, including a well-run, low-cost commodity producer that was willing to sacrifice some profits to be able to balance out losses in difficult times. This point bringing us into selling gold process, which is the last process in Barrick's value chain. There are two types of investors in the gold mining business, ones that live for the volatility of their prices and ones that prefer a more steady and predictable price, the latter being what Barrick focused on. Hedging in the volatile market of gold price risk was what made Barrick unique from the competition. They were able to hedge low prices with the risk of not gaining full advantage of the highest prices. This made it so their investors would have confidence in a profit, but they were fully aware of not being able to reach the highest of the high. Barrick's point in selling gold was not looking at that price, but to mine, process, and sell as quickly as possible, making their gold ounce outcomes higher than their competitors. Overall, Barrick was able to gain this competitive advantage in gold selling because of the depressed prices in gold when they began in the 80s would gain them lower priced gold mines. From the previous slides, we came up with a couple of questions. One, how limited would American Barrick be if they didn't use the hedging technique? And would this have caused an effect with the rest of their strategical ideologies, this considering the exploration, or in other words, the purchases of the mines, the acquisition, etc. The second question is, do you think that American Barrick could have been as successful, in other words, continued their success in another form, without the Camflo finding and eventually the purchase of it? And this is also in regards to the fact of Robert Smith. This excludes Robert Smith as the engineer and eventually becoming the president of American Barrick. Why and how so? We came up with that if American Barrick did not use hedging for their gold price risk, they wouldn't necessarily be limited, but they would be attracting a different investor crowd. They would have been able to gain out of the high prices, but would have suffered when the prices were low. They would have to hold on to gold that they mined for a profitable gold price per ounce. They wouldn't have been able to purchase as many mines because they wouldn't have used bullion loans with banks, which would have costed them one of their most successful mines, the Gold Strike. They probably wouldn't have acquired Camflo Mine when they did, and thus lost the opportunity to work with Robert Smith. Their process in selling of gold would have purely been defined by the current price of gold and would affect them drastically if the price was low. Most of their acquisitions and explorations was ultimately luck, but that luck derived from their hedging techniques. American Barrick could have been successful still without acquiring the Camflo mine by also not acquiring Robert Smith, but in a different form. They still had the same people on the team that helped them acquire Camflo, so why not be able to further their acquisitions? The value of hedging was still a part of the company prior to Camflo findings and purchase. They may have diverged differently in their journey, but ultimately their success was already prevalent before Camflo. Continuing with the industry, but now the motive to hedge. Barrick took money from investors to fund a mining project and promised them at least 3% of the mining output. If the price of gold was extremely high, the gold trust would then pay out 10% of production. This was a safe bet for investors in the worst of times and a big payout in great times. The gold trust paid 3% of the mine's gold output if the price was equal or below $399 per ounce, and paid 10% if the price was $1,000 per ounce. The company raised $17 million in 1984 to finance an expansion using the gold trust. It was a win-win situation. Their investors would benefit from the increase in both volume and the price of gold. This kept the situation intriguing and helped maintain the investors' trust in Barrick's actions. The bullion loans and the gold index approach. They took a loan from banks in the form of gold from their reserves and used them as a spot rate to pay for projects. Then they would repay the loan in gold that was mined from the project plus the interest. This would help them with attaining more mines, and the banks would also get a benefit by receiving bullions and being able to turn around and resell them right away. They received 77,000 ounces of gold and sold it immediately. It's a type of bond that has a flat price and annual interest payment, and then a sell price that is relative to the length of the term that the note was held. The gold index loans were used to help raise capital for gold expenditures. These were not used as collateral by the firm's mines. It was more for the sake of raising capital on their own dime, or an investment, if you will. In 1987, the company offered a 2% $50 million gold index bonds to Eurobond investors. Moving on to Barrick's risk management program. Their program involved three major financial tools: the forward contracts, options, and the spot deferred contracts. Hedging gold price risk is something that gives firms like American Barrick the competitive advantage, specifically for American Barrick for the years 1984 and 1992. This allowed the firm to transfer the risk by taking equal and opposite positions in two different types of markets. American Barrick chooses to go in a different path, unlike other gold mining firms, and then starts dealing with the risk at an additional cost. The forward contract. The why? It's meant to stop the price of gold from causing them to cross their break-even point for cost. How it worked is that forward contracts were started in fear of declining gold prices in the early 80s, so they would go into contracts that would specify a price and date for redemption. This price would be higher than the declining prices. They would sell at the lowest 10,000 ounces of gold at a specified future time and price. This would ensure that they would receive that price even if the market gold price declined. This was ideal for the situation they were in because gold prices were threatening their profitability. The extremely volatile nature of the gold market meant that the risk of very low prices was profound. American Barrick hedged against this risk by enacting forward contracts. Some of the advantages were the low sale prices of gold that would not affect their earnings because they had contracts to guarantee a payout. Unlike the disadvantages, they would lose any potential profit if the spot gold price is higher than the forward price. This made a promise to deliver a specific amount of gold at a specific time. The quantity produced would also be known, or should be known. Although forwards were used as a way to help mitigate and avoid some risk altogether, they began to become quite costly as the price of gold dropped. The options. Why? The firm decided to start in options contracts because they would be able to benefit off of the increased prices. Unlike with the futures contracts and still hedged lower or declining prices, this meant excuse me, this meant they could protect against lower dips while still seeing the higher gains from high prices. Their strategy was to create a way to see the upside of the gold prices but to eliminate the down. They would call or put contracts that had higher range upper prices so they could see the benefit. They wouldn't be able to surpass the prices, but they would be able to get higher up than with the forward contracts. The how? This was by buying put options and selling call options simultaneously. They used the premiums earned on the sale of calls to purchase the puts. This meant that there was no initial cost towards this strategy and it was much more flexible than a forward contract. Some of the risks were that they mitigated was not only to avoid declining prices but to take advantage of higher prices. The call owner can execute the option and buy the gold if the prices drop before the contract became expired. That would make the company lose a lot of money by selling at a lower price. Some of the advantages was that the option set a floor and ceiling for Barrick sale prices. Make a profit if This made a profit if the market price became higher and collected the premium to be used to buy call options. One of the disadvantages was to lose money if the call owner executed the buy when the gold prices were lower. Unavailable options contracts no longer than 5 years. The quantity produced is unknown or can be unknown. And why it's better? There are no initial costs because the premiums are covered. Some higher profits can be seen because of the difference between the call and put option. The spot deferred contract. Why? This allowed the firm to deliver the gold in a variable timeline. This forward gave the company a longer period, 1 to 10 years, to deliver. How? American Barrick created contracts with the buyer promising to pay a predetermined amount of gold at a given time in the future. If the price of the contract was higher than the spot rate at the time the contract expired, it could choose to roll the contract into a new period and just sell the gold for the spot rate intermittently. The key to make it successful is to deliver the gold when the price is low. The risk? They were able to negotiate many contracts and span a much wider range of time, ensuring that more of their production from a single mine was covered under some type of hedging program. The advantage was to be able to set a minimum price on their gold that was not related to the spot rate. Also be able to profit from higher prices. One of the disadvantages is that the investors could force the company to pay the balance if American Barrick's financial position weakened or if they exhausted all of their reserves. Why this is a better approach? Instead of just creating a price floor when the spot rate was low, the company could choose their intended minimum and negotiate with the buyer. They could also sell gold when the market was extremely high, allowing them to benefit from the highest prices yet. The big picture. Sources of success. American Barrick was widely successful because they understood how to appeal to their investors and how to reduce their risk for selling gold. By understanding the needs of their investors, Barrick was able to capitalize on the fluctuations in gold prices by providing lucrative investing options such as the gold trust mentioned earlier. By providing alternative solutions to raise capital for themselves as well as provide investors with a handsome return, American Barrick was able to fully fund their mining operations without worrying about the payback becoming too costly. Another source of American Barrick's success was their ability to learn from their past experiences to find new and innovative methods to hedge against falling prices of gold on the market. The team moved slowly and steadily to improve their risk management techniques by identifying what vulnerabilities they were subject to. and then establishing ways to mitigate the identified situations. The company then re-evaluated their positions by identifying flaws in the established risk management technique and finding a new way to suppress it. This method of self-assessment is crucial for all companies in order to identify weak points and improve upon them. By implementing forward contracts, they were able to reduce their vulnerability to the downside risk of gold prices. Then, after noticing they were not benefiting from high price fluctuations, they implemented simultaneous call and put options technique and later moving to SCDCs to incorporate even more gains. The sources of success. American Barrick also understood how the business of gold mining operations was susceptible to sunk costs that could not be recovered, as well as the expensive equipment and facilities required in order to complete the extremely complicated task that is gold mining. The company became well versed in the process of extracting the gold ore from the earth and refining it to produce the necessary grade of the ore to best fit the market conditions. Barrick also made strategic acquisitions of mines that were close to other production sites in order to use facilities they already had, which would then streamline the costs. American Barrick had a best practice established to mine and produce as much gold extremely quick in order to reduce the long-term cost of mining operations and to better be able to predict the gold price once production was complete. Continuing with sources of success. The main source of the company's success was their strategic acquisitions in mines that ended up being extremely profitable. Two examples came from the acquisition of the Meckel mine, which nearly doubled its expected annual output, as well as the Gold Strike property in Nevada, which was purchased for very cheap as it was only projected to have 600,000 ounces in reserves. Upon further exploration, the property turned out to be much larger than expected and produced more than 20 million ounces in the end. From a bigger scope, and continuing with the big picture, can it be repeated? American Barrick held no secrets about what type of risk management practices they were using and why. The company maintained well-documented positions regarding their methodology for hedging the price risk. Because of this, many firms use similar strategies today in order to protect against falling prices. However, much of their success stemmed from the market at that time. That is, because the gold market was in such a novel place, Barrick was able to emerge into the market with new ideas and capitalize on the platform of price stability and financing opportunities that paid dividends for both investors and the company. It would be very difficult for this type of performance to be emulated now because the investing approach of sacrificing short-term gains to cover long-term losses is widely known and accepted. Had gold prices increased over time rather than decreased, many of the hedging techniques put into practice would not have been necessary and probably would not have been put into practice. The company would have been amongst many other investors to reap the benefits of high gold prices, but would not have become so well known for their risk management practices. This is the end of our presentation. Thank you for taking the time to listen.